So thank you all so much for coming. This is joint work with Murat Salik from Toronto, Shutian from Georgia, and of course Tony Whited from Michigan. The paper is a bit interesting in the sense that it'll combine a bit of both theory and empirics. So we'll begin with some theoretical simulation and then move on to an empirical model, which actually analyzes the sort of real life event application, the Tax Cut and Jobs Act of 2017. We'll discuss some of the results, and that will get us to the conclusion. So we're all familiar with event studies, right? There's the idea that a high degree of anticipation can make for some really misleading conclusions, just because, you know, if everything is fully anticipated, you really won't see much of a reaction on the day the uncertainty is technically resolved, because really the uncertainty was all but certain even in the run-up. So one thing that has maybe not been formally quantified is just how much bias this can introduce. So we run some simulations to quantify this. And then, building off some of my own prior work, we propose a method to actually correct this in a more complete way than had previously been done. There have been approaches, some of them my own, to correct for these issues before, but in more sort of specific cases, this is a even much more general approach still that we will propose here. And the point of all of these approaches generally has been to create a structural model of payoffs to the underlying asset that's exposed to some sort of shock in both outcomes, the one that actually was realized, as well as the counterfactual. And of course, if you take the ratio or the difference of the realized versus counterfactual outcomes, that should get you the true impact. So how have people generally dealt with this stuff before? Well, the earliest approach has actually been to use firm characteristics. And that, of course, works very well for specialized kind of events where you know what characteristics might drive anticipation, but it is perhaps the least generalizable, because that means that for each type of event, you have to find, test, and collect these characteristics. And some events, ones that maybe span multiple kinds of firms, might not have very obvious characteristics that you could call upon. The second approach that I've contributed myself to is using both stock and option data to sort of over-identify these counterfactual payoffs. That has been applied a lot in M&A, but also has actually been applied to sort of a economy-wide event in a paper that I had in 2016. And finally, the third strand of these sorts of approaches has been to look at predictive markets as a way to measure the degree of anticipation without even looking at the specific asset, just essentially look at the betting market's probability. And that, of course, has been a promising line of research as well, with the caveat that, first of all, not all events, in fact, only the biggest events really have a betting market on them. And these markets are much more illiquid than the actual financial markets. So they're perhaps biased even in the cases where you can get that data to begin. So with that sort of setting, what we do is we contribute a new method that can actually uncover a heterogeneous impact of a market-wide event. In other words, our big contribution is that you no longer need to specify ex ante which outcome would be the preferable one. We can actually have the data tell you. And the reason that we chose to sort of illustrate our approach with the Tax Cuts and Jobs Act is because that's a great example of an event that fits both of these characteristics. It's highly anticipated. It was a virtual certainty that tax cut reform would be passed even when Trump took office, before any sort of legislative debate started. But it's also heterogeneous in the sense that there were clear winners and losers, and some of the characteristics that would drive them, as we see exposed, are things like innovation, overseas operations, and of course, as a tax reform, your tax assets or liabilities. So how does anticipation actually affect inference around an event like this, assuming we don't do any fancy methodology? Well, if an event is, let's say, 80% anticipated, we can quantify using simulation results that actually the correlation between a price reaction and the true event impact is less than 50%. And for one that is very highly anticipated, like the Tax Cuts and Jobs Act was, which we know from prior research, from betting markets, and from our own results, in all cases, the probability of it happening was well over 90% ex ante. The correlation actually drops to 20%. So that means that really the sort of measured outcome and the true outcome are, I won't say completely uncorrelated, but are not very correlated at all. And if you want to sort of look at an aggregate impact by totaling up the effect across all firms, the problem is that since there's so much anticipation and thus so much randomness in whatever else remains, the aggregate effect ends up being pretty much zero with high anticipation, even if the meaningful effect is true. So what we do is we derive a new approach to handle this situation where an event is both highly anticipated and heterogeneous. And we apply it to the Tax Cuts and Jobs Act, which gets us a impact estimate of about 12%. So sort of controlling for the high degree of anticipation, and also showing us that this event was strongest for growth firms with high patent counts. So prior to this work, there has been no satisfactory way to address a highly anticipated event with heterogeneous outcomes, aka both winners and losers. Of course, these types of events should be the most important. And our simulation results show that these are the ones where actually inference is most likely to be misleading. So our main contribution in the study is just to provide a way forward to address these events. Now, how do these sorts of things generally get handled? Obviously, we're all familiar with event study methodology. To sort of present it in our context, let's say that you've got two possible outcomes. The event happens, the indicator variable becomes 1, or the event doesn't happen, the indicator variable is 0. And the way that the impact of the event could be parameterized is if you have just some constant S specific to the individual firm. That could be either greater than 1 or less than 1, and that would affect the price of the firm as a function of the current value of the, or let's say not current, but the value of the asset should the event not happen, as shown in this equation here. Basically, if S is greater than 1, this event would create value for the firm, and if S is less than 1, this event would destroy value for the firm relative to the counterfactual where the event does not occur. So if we take those definitions of price and just sort of plug them into a expectation equation for stock prices, that means the price today should just be the probability weighted sum of the prices that could be realized tomorrow once we know which outcome actually happens. Either the event does happen, the indicator turns to 1, or the event does not, and the indicator turns to 0. So how do we actually then pin down or estimate what this impact of the event, this parameter S, should be? Well, what we can do is we can just look at returns, right? That's the standard event study approach. And if we have a case without anticipation, in other words, Q is equal to 0, this sort of simplifies very nicely to just S times, well, whatever noise there was in the prices around this period of uncertainty resolving is just S times the noise minus 1. So if the return was positive, that means S is likely above 1. If the return was negative, S is likely below 1. And of course, you can throw in a market model in there. You can control for abnormal returns in other ways. And you will have some uncertainty just because the price reaction would be noisy. That's captured by this epsilon. But what happens if Q is above 0, which of course it pretty much always is? Obviously, you won't have this easy cancellation that you see in the equation at the bottom of the screen. You'll have instead this messy expression that you see at the top. But how messy is it? One thing that I don't think we had a good handle on before we went into this is, well, is it at least positively correlated? If it's not perfect, is it at least a good proxy? In other words, would the estimate of the impact we get at least give us a sense of the ballpark of what the true impact was? The answer turns out, unfortunately, to be no. And furthermore, this is all firm-specific stuff. We can actually aggregate up to the sort of overall impact by just summing up S's price reactions across all firms. And again, if there is no anticipation, then we would have a reasonable estimate of the aggregate impact, just sort of as the average of the firm-specific impact, the mu sub S. But if there is anticipation, then perhaps the low aggregate impact could be due to high anticipation, or maybe actually a low mu S. In other words, it's impossible to disentangle. So what we do is we actually literally test this. We try different degrees of anticipation, different levels of noise in price data, and then we simulate what the estimated impact versus the true impact would be across sort of a continuum of degrees of anticipation. And we plot the correlation between the true parameter in the data generating process, the true S, and the estimated S for each individual firm. And so you can see that with very low anticipation, it's pretty good, above 80%, but it drops off dramatically after about 60% anticipation. And by the time you get to something that is as highly anticipated as the Trump tax cut, which was about 96%, the correlation is literally only at about 0.2. So unfortunately, the traditional approach is actually a very bad proxy for the true impact of an event. If we look at aggregate impact, and we sort of calibrate it to one with a true value of 12%, and we just try again different degrees of anticipation, we see that at the beginning you get something very close to the truth, but pretty much a linear drop-off. Interestingly, not a sort of exponential drop-off like with the firm-specific stuff, but a linear drop-off where by the time you get to high anticipation, it's very close to 0 pretty much no matter what. Again, just because the noise in the prices swamps the signal. We do some robustness for the magnitudes of the event's impact and the noise in the prices. Generally, we see very similar behavior. And so now how do we fix this? So we look at the TCJA as an example of a study that has both high anticipation and heterogeneous impact across individual firms. And we build off this prior work in options where we can say, all right, ex ante, prices both in the option and the stock are expectations of their values around both of these possible state contingent payoffs should the event happen versus not. We look at call options. The reason why it would not make sense to look for puts would be First of all, because short sale constraints are more likely to be present, thereby preventing efficient put prices, and also liquidity. So most of this literature uses call option data. So we have 5 parameters that we want to estimate: the probability of the event, the state contingent payoffs if the event happens and doesn't, and the state contingent volatilities if the event happens and does not. So the main problem with identification in this setting is the label switching problem, where you can have the probability of the event and the payoff in the event, or just as easily, what you could actually be estimating is the probability of the event not happening and the value of the event not happening. And therefore, you can end up with sort of your parameters flipping around without actually being able to pin down which is which. And in the past, we've gotten around this issue by just saying, in the settings we've looked at this, it's clear what the ordering of the events actually is. So for an M&A transaction, if the event happens, the target is pretty much guaranteed to be better off than if it doesn't. And in the Obamacare setting of my 2016 paper, again, the healthcare companies were more likely, anticipated by pretty much everybody, to be better off if Obamacare were passed than if not. But of course, this doesn't help us in the Trump tax cut situation, where potentially some firms could win and some could lose. So the way we get around this is we actually look at both possibilities simultaneously. We impose the constraint one way and we impose the constraint the other way. And we see how actually close we get. And we actually then pick which constraint is better on a given day by looking at how closely it actually matches the price data. So in other words, we let the data tell us for each firm, for each day, is it a winner or is it a loser as expected by current prices? Now that gets us sort of a day-by-day variation, but we obviously want to sort of come up with a ultimate winner versus loser classification. So the way we do this is we say that a firm is a winner if more than half the time it's considered to be a winner in the day-to-day analysis, and a loser otherwise. So again, the data tells us then which constraint makes more sense for each firm. And then once we've got that, we can actually then reimpose the constraint consistently, whichever one made more sense, and therefore get the value for that particular firm, whether it is a winner or a loser. So I think I've got just a couple of minutes left. The way that we can actually get a sort of specialized version of this approach to our paper is we pool data across all firms and set a common probability of the event for all of them. That, of course, gets us a much more powerful identification of the probability of the event, potentially with the problem that, does that then require us to estimate these state contingent payoffs for all firms all at once? We look at 100 firms just for sort of liquidity reasons. It doesn't make much sense to go beyond that, and we capture a sizable chunk of the market with the ones that we do look at. But does this mean that we actually have to estimate 401 parameters all at once? And would that actually outweigh the benefit of having more observations each day to identify the probability of the event? I've run these sorts of models before. If this were the case, it would certainly not. But we sort of benefit from the insight that really all of the other stuff, the state contingent payoffs, the state contingent volatilities, really only depend on each individual firm's data. So the only thing we have to estimate across all firms is the probability Q. So here's what we do. We chop up Q into sort of discrete intervals on a grid in increments of 1%, but that's just sort of a parameterizable option. And then for each firm and for each possible Q, we estimate the firm-specific parameters. And then finally, once we've got those state contingent payoffs and volatilities that optimize the firm's distance from observed to theoretically implied prices for each day, we then pick the aggregate Q that minimizes the price error across all firms. So that way, we're actually able to solve both problems at once, the individual firm payoff and volatility estimation and the global Q estimation. Now, Feng, you'll give me a warning, right?
Sorry, yes, 5 minutes exactly.
Oh, okay. I thought I had less time than I did. Wonderful.
Yeah.
So in that case, we can go a bit more leisurely. The data comes from option metrics and CompuStat. The time period that we chose is the period over which debate was held. The measure was proposed on November 10th, and the final vote was held on December 2nd, which just happened to be a 30-day window. But of course, again, this idea was a near certainty in some shape or another, pretty much starting in early 2017. Now, as I was saying, we pick 100 firms, which are the highest by option volume during this period, and they're pretty well representative of the option market, sort of as far as daily call volume. These 100 firms capture between 29% and 50% of all the option volume in option metrics. And of course, remember, options are pretty much the key input into this approach. They provide most of the data restrictions because in each firm-specific estimation on each day, we use 6 options, and 1 stock observation. So the options provide the bulk of the identifying restrictions. But also this set of 100 firms, of course, turns out to be some of the largest firms because naturally optionality goes along with size. And we capture about 22% of the CompuStat market cap. So while we aren't really going to be able to say that we get sort of the sum total of the event, we get a meaningful enough chunk of it. Now, why don't we go beyond 100? Well, because even when we get to, let's say, firm 99 or firm 100, you start to see contracts that have 0 volume. In other words, remember, we must have 6 live contracts per firm per day. And if a firm is down towards sort of the lower end of this continuum, some of these contracts actually don't get traded. So what we're looking at then is a quoted price. In other words, not an actually traded price for the option. And this is something that I've come across in prior work as well. The more either firms you include or the more option contracts you include per firm per day, the more likely you are to end up with these. And generally, these are not good. They're noisy, and your estimation becomes worse and worse the more of them you include. So because of that, we decided to truncate it at 100. The other data that we look at is innovation measures, tax assets, liabilities, things that are sort of related to the outcomes of the event.
Hey, Paul, 1 minute left.
Thank you. So then we're actually able to apply this approach, get a global estimate of our probability. You can see that it's uniformly high at about 95, 96%. We use bootstrapping to get a confidence interval. Even that drops only as low as about 75%. And we get a very meaningful difference between the estimate of the event that we see versus what you might observe in sort of more traditional methodology like CARS, even out to longer time windows, which of course has been the approach people have advanced to try to control for this anticipation. Like, well, why don't you just make your time window longer? Then you'll get a better estimate controlling for anticipation. The problem is you don't, because you have, again, more noise. As far as what makes winners and losers, that's a fairly lengthy discussion. But suffice it to say that innovation and tax assets and liabilities drive the reaction of the price data, which then tells us the impact on the firm. And this works either if we look at the impact ratio across characteristics, or the characteristics across impact ratios. So finally, then, what have we sort of done here? Well, we've got a method that can estimate the ex ante event probability for heterogeneous and highly anticipated events. The Tax Cuts and Jobs Act was a perfect illustration of this, because it was very likely to be to take place. The impact is, in our case, measured at about 12.36%. In other words, that's the gain overall to the firms in our sample relative to the counterfactual of it not happening. But that is magnitudes higher than the impact you would infer just by looking at the price reaction, which would be a meager 68 basis points. We also show theoretically through simulation this downward bias in the aggregate impact, which in our data would be effectively 0 without controlling for anticipation. And sort of the policy implications of our research specific to TCJA, of course, would be that we show that it does impact large firms with high patent counts and high growth prospects more and more positively than otherwise. This sort of feeds into the discussion of what innovation strategies firms can pursue. Some pursue sort of highly impactful small count of patents. Think about Moderna, for example, and others pursue a large number of mediocre patents. And it seems like the Tax Cuts and Jobs Act seems to encourage the latter, which may have some implications for macro optimality. But more broadly, this sort of approach can then be used to analyze literally any other policy event on which affects multiple firms with traded financial options. So that's my story, and I'm sticking to it. Thank you so much for listening.